Hello and welcome to SCCA Masters. It's our first lecture on the paper FA2. First of all, let's discuss about the exam pattern. In your exam, you should expect 50 multiple choice questions and each will worth 2 marks. And you will have 2 hours to complete your exam. And you have to score at least 50% to pass this exam. Without wasting any further time, let's start our first lecture. On your screen, we have some basic accounting principles, in which first of all we will talk about going concern. It is the assumption that the business will continue its operation for the foreseeable future. Okay, so when we prepare our financial statement, we assume that business is a going concern. Okay, that means we are expecting that business will continue its operation for at least 12 months or more. And we also expect that according to our knowledge, there is zero chance of business failure. So that is the concept of going concern. Now let's say as an example, if a business is not a going concern business, then in that case, the financial statements will be prepared on the breakup basis. Breakup basis. That means its preparation will be different than the preparation of normal financial statements. Next, we have a concept related to accruals. Incomes and expenses should be recorded when they actually incurred or occurred, not when the cash is received or paid. Let's say, for example, today is 31st of January, okay, and you are expecting your salary for the month of Jan, okay, but due to any reason you get this salary on, let's say, 10th of Feb, okay, although you are getting your salary on the 10th of Feb, but still we will record it for the month of January, okay. And similarly, let's say we have a bill which is related to the month of Jan, but we are paying this bill, let's say, on 10th of Feb. Then although we are paying this bill in the next month, but it will be recorded in the month of Jan. So that's all about accruals concept. Next, we have a concept related to consistency. Financial statements should be prepared using the same accounting method, policies, and standards over time so that we can compare our previous year with our current year. Double entry. Each transaction have dual effect and we have already talked about it in FA1. Every transaction has matching debit and credit entries in the bookkeeping system. Business entity. Accounting records record the transaction of business entity, not the transaction of its owner. That means business is a separate entity than its owner. Next we have materiality. An item is material if its misstatement, omission, or error could change the economic decision of the user of financial statement. Historical cost. Transactions are recorded at their historical cost. And finally, we have prudence concept according to which assets, liabilities, income, and expenses must neither be overstated and nor be understated. Now we will study about accounting equation and calculation of capital. First of all, if we talk about accounting equation, then we have already studied accounting equation assets is equal to liabilities plus capital. And sometimes we also call our capital as equity. Okay, so both are the same thing. You can either call it equity or you can also call it capital. We can change this equation slightly. For example, we can write it as capital is equal to assets minus liabilities. And this part of the equation also known as net assets. net assets. That means we can also call capital is equal to net assets. I hope you understand this equation. So now we will study that how we can calculate capital. Okay. So just remember this pro forma. First of all, we have opening capital, then we add profit for the year in this opening capital, then we less drawings from this amount, and in case if the owner has injected new capital, then it will be added. And finally, as a result, we will get closing capital. And based on this pro forma, we can solve different questions. Now here on your screen we have some questions. Let's do them one by one. So first of all, Andy started a business and introduced a capital of this amount. Okay, so we have capital of $10,000. He also obtained a loan of this amount to purchase a non-current assets. And the requirement is what is the value of Andy's opening net assets. So here we are required to calculate net assets. So as we discussed, net assets is equal to assets minus liabilities. Okay, and this equation is equal to capital. So we can say that our capital is equal to net assets. So because the amount of our capital is 10,000, so our answer or our net assets will be 10,000 in this case. For now, I am going to skip this question, but later on we will attempt this question. Then we have our next question, according to which on this date J used cash to pay the rent on her business premises for the 3 months to this date in advance. So if we are paying something in advance, that will be a prepayment, and we will always categorize our prepayment as asset. So in this transaction we don't have any effect on liabilities and capital, but here we are paying cash. So if we are paying cash, then that means we are reducing the amount of cash, or we can also say our assets are also decreasing. Alright, but on the other hand we are making a prepayment, that means our assets are increasing by the same amount. So that means there will be nil effect on the assets of the company. So here in this case our answer will be A. Our assets will be unchanged, our liabilities will remain unchanged, and our capital will remain unchanged. Now here we have next question. The profit made by business in 2007 was this amount. The proprietor injected new capital was this amount during the year and withdrew a monthly salary of this amount. Okay, so here we have withdrew, new capital, and profit for the year. Now the requirement is if the net assets at the end of 2007 were this amount, what was the proprietor's capital at the beginning of the year? So here we will write that pro forma which we discussed earlier, that was opening capital plus profit for the year minus drawings. Then we add up any new capital in case if the owner inject any new capital during the year, and finally we get answer of closing capital. Now when we will go back, for example from closing capital to opening capital, then whatever we are adding here we will subtract that amount, and whatever we are subtracting here we will add up that amount. Okay, so here we have the amount of our closing capital, which was 95100. We have some new capital, which is this amount. Right now we will less that amount, 10,200. Then we have drawings. We will add up drawings. Okay, so here we have drawings of 500. It is a monthly salary. Now please remember one important point. We have to consider full year's drawing. Okay, so that means for that purpose we will multiply this 500 with 12 months. Okay, and that's how we will get 6,000, which is our full year's drawing. So we will add up this 6,000 into this amount. Then we have profit. We will deduct the profit of our current year, which is 35400. So I am going to less or deduct 35400, and finally as a result I will get 55500, and this amount will be our opening capital. Okay, so here we can write 55500. It was a pretty straightforward question. I hope you understand it. So let's do the next question, which is question number 5. What was the profit or loss made by business in year 9? A business had net assets at 1st January and 31st December year 9, which was this and this respectively. So we can say that it is the net assets at the start of the year, and these are the net assets at the end of the year. During the year, proprietor introduced additional capital of this amount and withdraw the value of this amount. What was the profit or loss made by the business in year 9? So again we have to write down the same pro forma, and we know that we have to write opening capital first, then we have profits or loss for the year, then we less drawings, and in case if there is any additional capital, then we have to add up it, and finally we will get closing capital as a result. Okay, so please first of all write down the values. We have opening capital of this amount, which was 75600, closing capital of 37800, then we have additional capital of 17700, then we have drawings for 16300, and this is the amount which we have to calculate, right? So again we will do a backward calculation. Okay, so that means right now we will deduct this 17700 from this amount because we are going back. So it will be 37800, which is our closing capital. Okay, and we are deducting any new capital from this amount, which is 17700, and we are adding up drawings into this amount, 16300, and now finally we will deduct our opening capital from this amount. So here we have the opening capital of 75600. Okay, and now if we perform the calculation, then we will get the answer of negative 3200. That means it is our loss. Okay, and one more thing, it is the answer of our question number 2. For example, in order to calculate profit, we have to deduct new capital from closing capital, we have to add up drawings into that amount, and finally we have to deduct our opening capital from this amount. So here is our question number 2, which we skipped earlier, and it is the right answer, which is option B, because we are required to calculate net profit for the year, and we have this formula: closing capital, from which we are deducting our new capital and we are adding up drawings for the year, and finally we were deducting opening capital, and that's how we were calculating our net profit. Next we have question number 6. Which of the following is bank overdraft an example of? So bank overdraft is a short-term loan from bank. Short-term loan. That means we take it for less than 12 months. So we will categorize it as liability of the business. Next we have question number 7. Which two of the following are included in IASB's conceptual framework for the financial reporting definition of an asset? For that purpose, we have to recall the definition of asset. So, asset is something which you own and from which future economic benefits are probable, and it arises as a result of any past transaction or as a result of a past event, and it is controlled by entity. Fine. So according to this definition, it is a source controlled by entity. Okay, it's true. It results from a past event. Yes, it's true. There is expected to be an outflow of future economic benefits. No, it's not true. Instead of outflow, we expect inflow. So that's why it's not true. And finally, increases in the economic benefits in the period. It's also not fall in the definition of asset. Next we have question number 8. A business borrowed this amount from its bank and used the cash to buy a new computer. So that means here we have two different transactions. So first of all, a business is borrowing something from bank. That means if the business is borrowing this amount from bank, then it will increase your cash. Okay, and at the same time it will also increase your liability. On other hand, if we talk about the second transaction, then here you are purchasing something for cash. So that means our cash is reducing by some amount, but on other hand, our non-current asset is increasing with the same amount. That means in this case, there will be nil effect on our total assets. Okay, but if we combine up the effect of both of these transactions, then our liabilities and our assets both are increased. Next we have question number 9. What is the main purpose of statement of financial position or balance sheet? Option A is to report assets, liabilities and capital of the business at particular date. And yes, it's true. Its main purpose is to report the assets, liabilities and capital of the business at any particular date during the year. Okay, so this statement is true. You may also read the other options, but these are incorrect. Next we have question number 10. Which of the following correctly calculates the difference between closing capital and opening capital? And I hope you can do this question by yourself, as it is pretty straightforward question. Our next question is question number 11. At the start of the year, the balance on the debtors capital account was this. So it's our opening capital during the year. David made drawings of this amount. It's our drawing. And net loss, we don't have profit for this year of this amount. He also introduced capital of this amount. Again, we are required to rewrite the same performance. So first of all, we have opening capital, then we add up profit for the year, then we deduct drawings, then we add up any additional or new capital, and finally we get closing capital. So our opening capital in this case is 85872. We don't have any profit for this year, we have a net loss. So we will deduct this amount minus 1700. We have drawings of 19500, We will also deduct this amount and we will add up our new capital, which is 5300. And if we sum up them, then we will get 69972, and that is our answer. Next we have question number 12. What was the net profit for the year ended December 3? The net assets of Kate business were this amount at 1st Jan 2003. That means these are the net assets or capital at the start of the year. So it is our opening capital. And this at 31st December 2003, for example, at the end of the year. So it is our closing net assets or closing capital. During the year, Kate paid personal funds of this into business bank account. That means the Kate is injecting some new funds into the business bank account. So it is the additional capital. And finally, the Kate is making drawing of this amount. You are required to solve this question, as this question is similar to the question number 5, which we have just practiced. Next we have question 13. The owner of small business which does not have an overdraft facility draws out some money for personal use. So here the owner is drawing something from the business. So that means our cash will be reduced, and that also means our capital of the business will be reduced. Okay, so our assets will be decreased and our capital will be decreased in this case. Next we have the final question for this lecture, and it is also your home assignment. A sole trader had opening capital of this amount, closing capital of this amount, and during the period owner introduced capital of this amount and withdraw this amount. Okay, and you have to calculate profit or loss during the period. So that's all for this video. See you in our next lecture, and in case of any question you may text me. Thank you very much.